Let's talk about real estate specific, housing market numbers specifically. You have a chart here, rentals under construction as a share of total rental stock. And one thing that's pretty shocking, not shocking, but kind of shows up for me in this chart is really BC, Alberta, the bulk of the Western Canada is where there's so much of this kind of my question is that where the overbuilding situation is going to be? Because as you can see, BC is in the lead here. This is as of May 2025, so a couple months ago. But BC, 15% of the rental stock right now is under construction. So that means there's going to be a ton coming on the market, and that means it's got to be absorbed very, very quickly, which means if there's a lot of immigration or in-migration, that can happen. But without it, it could sit on the market. Am I reading this chart the way you would read it? I'm seeing this, yeah, go ahead.
Yeah, well, it's a percentage of their provincial building, right? So it's a percentage of the overall overarching kind of rental housing stock. So here's the thing about it. Both BC and Alberta have had over the years a propensity to draw the most immigration or be a big source of immigration moving into that province. Alberta continues to be that way. That's what I'm saying. So Alberta, as much as it feels like overbuild right now, and even as you look into the future, there's a risk of it. The absorption, which I said earlier on, it's going to take some time for the rental stock to be absorbed given the immigration coming in interprovincial and direct immigration. So then that's the Alberta side of it. But economically, Alberta's remaining quite strong. BC, on the other hand, and I can't help it, it's NDP government. We're running another bigger deficit. We're going more into debt. The economy is in fact slowing down. So there is a very strong chance of certain parts of British Columbia overbuilding. And I'm talking primarily Vancouver and Lower Mainland. Like right now, Kelowna is pretty great as an example. So there are pockets within British Columbia that aren't at the same effect, but that's kind of what's going on in that. So purpose-built rentals is right now BC and Alberta are the highest in terms of percentage, but they also historically have the highest immigration.
Interesting, Patrick. We'll see how that, we've been tracking this one for a while, and we're going to keep tracking it and see how it goes. One last kind of number I wanted to discuss before we get into the YouTube comments, and that's becoming my favorite part of this show is the YouTube comments. So I'm excited for that. But I've been saying on this show and to you privately, but definitely on this show, I've been saying, right now it is the toughest it's ever been to go find money for great projects. If the banks are tightening up, B lenders are tightening up, everybody is tightening up. It is a lot of work to get these deals done. I'm getting them done, but it's a lot of work. It's more work than it's ever been before. And when I saw this chart about bank loans and this kind of crazy vertical hockey stick, it's like, it looks like a year ago or so, roughly, the number of billions of dollars that the banks had outstanding in real estate shot up. I mean, we're talking, from 30 billion to 80 billion, which this kind of, when I saw this chart, I thought to myself, oh, this is why they're being so damn restrictive, is they've tripled their balance sheet in the real estate world in less than a year. It's never been that high, not even close. They typically have been operating in the 10, 15, 20 billion range. They brought it up to 30 billion, and then they went from 30 to not 80 billion. Like, holy crap. So am I reading this right, Patrick?
100%. And it's continuing to climb. This is the fundamental kind of, we got to pay attention to this. And so let's go back to when you even pointed out, like when did they really crank it up? And it coincides directly with the meltdown of the condo market, pre-built construction being shut down, or pre-built construction sales being shut down. Developers have to pivot. So number one, they had to go in, they're trying to carry, they're doing bridge financing. I mean, it's so complex and so much going on. They're also pivoting into that multifamily space. They got to keep people working. They got to continue to pay the bills. They're figuring out ways to pivot around this issue called condo pre-sales have dried up. So in behind all this, JG, is that's not the only part of this. So they got multifamily space, you got CMHC lending money. There's such a huge risk in their books. And this is where it gets a little crazy, because CMHC, okay, so the government backs the CMHC loans, right? So we realize that they're lending a lot of money out, but now those loan to value ratios have totally shifted. So they're arguably underwater. I think it was you that we talked about where they're actually, CMHC is saying, no, you need more money in on this deal because of the way the values have shifted and changed, dropped. So there's just a lot of risk in the market right now. That's definitely a concern. But where are developers going to go? I mean, many have shut the doors. Like it's not being talked about a lot in the general public. In the industry itself, people know there's some big developers that have either closed their doors. There's a lot of developers who have some cash who are just shutting down projects, and they've got the cash to do that and kind of weather this next storm. But these are all the things that are going on in behind the scene. There's a lot of banking risk there. Government, of course, as if somebody forecloses on, or somebody shuts down, or what's the term? So they build a project, CMHC financing, they default on that. Who's paying for that, JG?
CMHC insurance.
Yeah,
that's what it's
the
for.
The people. So, we're paying for that. So these are all the risks that are in the market right now. And this is go back to what I said earlier, where we've had a whole economy built on housing and housing construction and housing sales. And now that that's slowing, this risk, by the way, is not really being talked about. So you got a high risk of overbuild, and that won't show up for at least a couple of years before that even shows up. And in the meantime, we're starting to see the risk that CMHC is taking on and how they're trying to mitigate that risk. And again, to your point, it's why they're making it so difficult. But when you have an economy where liquidity starts to dry up, guess what? It's a self-fulfilling prophecy. Then we definitely continue to spiral down.
I have some questions on this chart though, Patrick, and I know it's not your chart, so you probably can't answer these, but let's just take condo development or any development for a sec, but let's just take condo development where, essentially the developer pre-sells a certain number of units, gets a construction loan, does, the construction, and then sells the rest of the units. When the developer sells the units, the people buying the units are not buying it with cash. A portion of cash, but most of them are financing that, 80% LTV, loan to value, 75% loan to value, so on and so forth. So my point is that the bank is always holding that real estate one way or the other. They either hold it for the developer, and then when it transfers hands to the owner, it may not be the same bank, but the bank in general, let's just say the lending industry, ends up owning most of that condo anyways until the mortgages gets paid down. My question is that how could triple the debt, almost, it's not quite triple, but almost triple the debt, get created? Because the bank is holding the mortgage for the developer or the consumer. And if the consumer's not buying it, that's okay. They're still holding it for the thing. But how did triple the debt get created? So I'm kind of curious on this chart. I'd like to dig into this one a little bit because it doesn't make that much sense to me. I'm a little confused by it.
Well, so you got developers who couldn't finish projects, who couldn't sell out projects, but have to carry it. So they're taking on more debt in order to carry this while they try and figure out how to sell stuff and or rent stuff. So that's part of it. Some developers have then moved into the multifamily space, which is what these loans are also accommodating. So there's a lot of it isn't any one thing. It's a number of things that are going into this particular chart. But I want to point out something here too, JG, is that the blanket appraisals are still happening. So in other words, what the banks are doing is saying, it appraised for $1 million 2 years ago. We're going to carry that appraisal forward so that these individuals can, in fact, get financing. Because if you bought that unit and you agreed to pay $1 million for it, and today it's only appraising at $750,000, that's a big shortfall. So what happens in that case is that the bank is So in that case, the bank is still appraising it at $1 million. They're still giving you the money, but they're individuals. So in other words, let's say they lent, let's say there's 500 individuals in that building that they've given that blanket appraisal to. They finance those loans. Most of those individuals will do everything they can to pay that mortgage. You follow? If they don't do that blanket appraisal, it all lands on the developer. So in other words, the developer has to go after the end user and try and collect money. In the meantime, how are they going to carry it? So CMHC, I think, looks at it and goes, we're going to spread our risk. We're going to spread our risk to 500 individuals in this example, as opposed to one developer. Because if one developer goes south, the whole building goes south. If, let's say, 200 of the 500 individual owners go south, then at least they've still captured something. You follow my thought process on that?
Yeah, I think that's a fair assumption on your part. And I, you've always said this, and I think it's 100% right. The average individual is gonna, go to hell and back to pay their mortgage, and they will not default on that very lightly. And that's why Canada's default rate's actually very, very, very low. Even by this point, Patrick, it was only 18 months ago. Everyone was saying default rates would be through the roof in 2024, through the roof in 2025. And now we push that back, and now people are saying, 2026 is going to happen, 2027 is going to happen. But at the end of the day, people do their absolute darndest to pay their mortgage, and banks have these little tools and these little tricks in order to make sure people don't default on those mortgages, because the bank doesn't want these damn real estate properties. They're not in the real estate business. They're in the debt business.
That's right. But they're mitigating risk. That's ultimately what they're doing. They're mitigating risk. They're spreading that risk rather than one developer who will take it all out versus, a bunch of individuals. I think that's part of how they're looking at the risk mitigation side of it. And that's what we got to do. I want to go back, and I know we're jumping around a little bit, but I do want to go back to talking about interest rates and the drop of interest rates. One of the arguments that probably a reasonable argument for a 50-point basis cut is our government debt and our government deficit, which they're borrowing to pay. So in other words, they're borrowing, from one credit card to pay another credit card, both of which are, maxed out. And so part of the, pressure that I'm sure the Bank of Canada is feeling, although they say they don't, I don't know, I don't agree with that. I think they're stretching the truth there, is think about the debt that Canada and any government, this is a global phenomena. Think about the debt that we as a country have, the deficits we're operating in. So no surprise that our federal government's not going to deliver a budget. All to say this is that is in fact an issue. Canada went to, I want to say, to service the debt is now 30% of our GDP goes to service our debt. And that's up from like 22%. So it doesn't seem like, 8%, that's a big number. I mean, the US is right off the charts. Yeah, huge number. So Canada fiscally is appearing more responsible, but we also have an economy that is like minuscule.
So if you like these episodes and you want to learn more about what's going on with real estate in Canada, investing in real estate, and understanding how to invest in real estate the right way, head on down to the descriptions below, follow those links.